With interest rates on the rise, more clients are giving consideration to an adjustable rate mortgage. However, is an ARM right for you? We'll talk about it in this week's Homebuyer Radio.
This is Homebuyer Radio with home loan expert Dan Morales. Dan has been one of the nation's leading mortgage lenders since 1991, and weekly he shares with you valuable insight into the home buying process. Whether it's your first home or not, Dan will help you have a better understanding of the home buying process. Let's get started with this week's episode. Dan, what do you have for us this week?
Hey, thanks, Pat. It's Dan Morales, America's Mortgage Man. This is Homebuyer Radio, episode number 179. It is February 13, 2022. And this week, I'm going to try not to get too deep into the weeds here, but I want to talk about just some quick changes that we've seen with interest rates and the ability to maybe give some consideration to an adjustable rate mortgage. Now, what we've seen over the course of the last month when it comes to mortgage interest rates is we've seen a strong move up in interest rates. That strong move up in interest rates, unfortunately, is going to impact the affordability for a number of clients. So if you had a mortgage pre-approval and that pre-approval is more than 30 days old, it is probably a good time to circle back with your lender and figure out what the increase in interest rates has done to your affordability. Remember, you qualify for a monthly payment, not necessarily a particular dollar amount. Now, the amount of a house that you can finance is impacted by things such as interest rates, property taxes, homeowners insurance, association dues, those kinds of things all can have an impact in your overall monthly payment. So when you see interest rates go down, your affordability can actually go up because the amount of money you can borrow with a lower interest rate actually increases, which means that you have more affordability. Okay. Now, the flip side is true. When interest rates go up, the amount of house you can buy goes down because the amount of house you can buy or the amount of dollars you can borrow, start to go down based on the increase in interest rates. So for clients who've got a pre-approval that's more than 30 days old, we've seen a nice move up in interest rates over the course of that last, let's say, 30 days. It is a good idea to update your numbers with your lender, because if you are looking at buying a house that was close to the maximum of kind of what they initially told you could qualify for, it's going to be important that you don't end up getting a property under contract that now you don't qualify for it because the interest rates have gone up and your affordability has deteriorated to a point where you just can't qualify for that much house, right? So there are times where I tell clients, you get to a point where, once you break a certain threshold in your debt to income ratio, it's game over. Like there's no more magic to be worked. There's nothing else we can do to increase the amount of what you're able to borrow, short of you magically getting a big increase in pay or all of a sudden finding a ton of cash that you can put in to the transaction as a down payment. So it's one of those things where it's really important that you're working closely with your lender. If you're one of our clients, of course, we're keeping on top of that stuff for you to make sure that you know how these changes in interest rates will impact you, so that you are looking at an appropriate price point for yourself when it's all said and done. Now, one thing, some clients should probably give some consideration to, and this is something that we haven't really talked a ton about in the podcast, and that's because over the course of the last probably 3 years that I've done this podcast, there just really hasn't been much of a market for adjustable rate mortgages. And a lot of times adjustable rate mortgages get this really bad kind of vibe to them because, a lot of people hear the term, oh gosh, adjustable rate mortgage, it just means you're going to get hosed, in the process. Well, what happened when you go back to the, housing bubble of 2008, prior to the housing bubble, there were a ton of adjustable rate mortgages that were done. Now, those adjustable rate mortgages that were done a lot of them were done as what they call Alt-A or subprime adjustable rate mortgages. And those mortgages were written under terms that were really meant to be unfavorable towards the consumer, meaning that, when those rates changed on those loans, the rates changed in ways that were really always going to be unfavorable towards the consumer. Now, what most people don't realize is that you still have the good old-fashioned conventional conforming adjustable rate mortgage that was being done even during that same period of time. Now, those loans actually ended up playing out well for clients because I had a couple of clients that were able to actually afford to be able to keep their house because they had an adjustable rate mortgage. And when the housing bubble took place, we saw this big drop in interest rates, and their interest rate on their loan went down automatically. And by that interest rate going down, they were actually able to keep their house without having to come in and refinance or do anything different. Okay. Now, an adjustable rate mortgage may or may not be appropriate for you. It depends on how long you plan on keeping the mortgage. If you plan on keeping the mortgage, let's just say for less than 5 to 7 years, an adjustable rate mortgage could be a really good fit for you. Now, notice I said plan on keeping the mortgage, not necessarily the property. A lot of times people will plan on keeping a property longer term, but the typical mortgage tends to run off within that 5 to 7 years, meaning that typically nobody keeps a mortgage much longer than 7 years on average, meaning that they usually end up refinancing, buying a different property, they got a promotion and made a ton more money and upgraded their house, or they had a reason to take cash or equity out of the property, or something just happened in life where they needed to do something different with that mortgage within, let's say, that 7-year timeline. So an adjustable rate mortgage can be a good fit if there's enough of a benefit to taking an adjustable rate mortgage. Now, if we looked at, let's say, an adjustable rate versus a fixed rate going back, let's say, a year ago, you wouldn't even give it consideration, because fixed rate mortgages were so dirt cheap that it made sense to take the fixed rate versus an adjustable rate, because they were either very close to being the same, or in some cases the adjustable rate was actually higher than if you took the fixed rate mortgage. Okay, well, with the recent run up in interest rates, we're starting to see the opposite happen again. We're starting to see fixed rates become more expensive, where an adjustable rate mortgage starts to look more attractive. In some cases, it could be potentially 0.5% better, maybe. So depending on what your duration is for buying the property. I just spoke with a client the other day. He's relocating because of a job transfer here to West Michigan. He's like, Dan, I don't plan on keeping my condo much more than 5 to 6 years. Hey, great. A 7-year adjustable is going to work really well for him. And in his case, he's able to get an interest rate that is far better than if he took a 30-year fixed. So there was a real benefit to him to look at that adjustable rate, because the shoe fit, right? Meaning that he wasn't going to keep the loan for longer than 7 years. And there was enough of a difference between the adjustable rate and a fixed rate that it made sense for him to take it. So it's one of those things that as you see interest rates go up, it starts to impact your affordability. Okay, when those rates go up and it impacts your affordability, well, how can I get some of that back, right? One way you might be able to get some of it back is to look at an adjustable rate mortgage. So it's an option that's worth considering. Now, if you're one of our clients or you're thinking about buying a house and you reach out to us, we're going to look at all of the options that are out there, including an adjustable rate mortgage. Now, one thing I will tell you, if I don't think it is an appropriate program for you or something that's going to work for you well, I'm going to tell you that, because I don't want you to ever take a mortgage where you look back and say, gosh, I wish I would have done that. That was the wrong loan choice. We really want to do our best to position you for the best overall outcome. And sometimes, believe it or not, some consideration to an adjustable rate mortgage can make sense, especially in today's world where they start to make more sense, where maybe they haven't made sense over the course of the last, several years. Really, probably the last decade, they haven't made sense. But we're starting to get to a market where, looking at the math most recently, they start to look a little more attractive, where it could make sense and it could benefit you. So it's something to give some consideration to. Of course, if you're in the market looking to buy a house or finance a house or refinance a house, we would love to help you out. Dan Morales, America's Mortgage Man. You can find me online at danmorales.com. That's DANMORALEZ.com. My MLS number is 709-729, and my phone number is 616-931-4629. Thanks for listening. Have a great day.
Homebuyer Radio is a production of Dan Morales, home lending expert with North Point Bank, NMLS number 709729. Dan can be reached at 616-931-4629 or online at danmorales.com. Thanks for listening, and we invite your questions and show ideas at homebuyerradio.com. All loans are subject to credit approval. This is not a commitment to lend. North Point Bank is an equal housing lender. All rights reserved.